Hey, everybody. Hope everyone is doing well. Go ahead and ask. If you haven't had a chance to ask your question, feel free to go ahead and ask it. And I appreciate everybody being patient with me. So, overall, today, a couple of things. One, I mentioned in the blog that I thought today would, I thought today was going to try and bounce. I don't have any lines drawn yet, and I'll get them drawn tonight. But if we look at this chart, we can see that you can argue we had a channel, we broke below it. But the more important thing to realize is this right here. We broke below this low right here, which is August the 18th. I'll draw it later. So that's August the 18th. We broke below it and we closed the breakout point. So bulls made money buying August the 18th low. And right down here, we broke below October the 3rd here. So what do you think is going to happen? The reality is the bulls who bought this low are probably going to make money. We're really close to 4,100. We came within about 50 points and we're bouncing back to 4,200. But right now, the odds are this is probably evolving into a trading range. And because it's evolving into a trading range, it's reasonable to assume that the market is probably going to rally and close this breakout point. So over the next couple of days, I think we're starting to go sideways. The bears that were selling down here, they were selling and they're disappointed. So these traders that were selling and now that they're disappointed, some of them are going to start buying back shorts. So overall, I think we're going to go sideways and try and bounce. Let me just check a setting really quick. There we go. So on the 5-minute chart, first bar of the day. And as always, first thing I do on any chart, take yesterday's high, which is the prior trading day. So if I say yesterday, I'm implying the prior trading day. I take yesterday's high, yesterday's low, and I immediately draw it on the chart. Now we have yesterday's high and low established. Bar one is a big bull bar closing on its high. And it's a big enough bar that on bar one that the odds are we'll get at least a small second leg up. So if you buy above one, you can put a stop below one, but at least 50% chance that if you buy above bar one, this bar, at least 50% chance will rally and then reverse. There's only a 20% chance that bar one is the low of the day. Give me just a moment here. Bar one, okay, buy. Now, one thing to think about right here is we have a really small tail below bar one, even though, and it's very common, if you look at the daily chart, this tail, I believe it's only one tick. 575 is the open and 5.5 is the low. So that's a one tick tail below the bar. Look on the daily chart. How many bars have a one tick tail above or below the bar? Even here, this bar right here, the open of this bar is 9.5. and the high of this bar is 1.25. So it's about a 1 point, maybe 2 point tail above the bar. And that, even though it's really, really subtle, that dramatically increases the odds that we're going to fall below one. But overall, I think we're going to pull back and closer to the moving average. We're getting near the 60-minute moving average, so we may have to get there. Bar two, consecutive bull bars, follow through. Okay, buy the close bar, but what do you notice? You're breaking out above the high of the day. So the traders that are buying the close of two, they're going to be really quick to make a decision because they know they're buying a possible extreme of the day. Bar three, look at bar three. Remember what I said about bar two? Traders buying the close of two are going to be really quick to make a decision. If you bought the close of bar two and you know that this might be the extreme of the day, this could be a failed breakout of yesterday's high. How are you feeling if you bought the close of bar two? Obviously, you're disappointed. So if you bought the close of bar two and the market went more down than it did up, that's a warning that you might be buying high in the range. So a lot of traders, if they bought the close at two, they were hoping that three would be another big bull trend bar, kind of like this big bull bar, another one here, a little bit smaller, but it still led to a second leg. So these traders who are buying right here, they might look to start selling. They buy the close of two, disappointed on three, and they look to sell out of longs back at their original entry at the close of two. And instead, we found buyers. Bar four, another bull bar. But because of three, three's kind of a pull, it's a pullback after a breakout, bar one and two. And with three being a small doji bar, I want you to think for a second. The video's delayed, so I'm not going to wait for people to answer. There's a slight delay of about 4 or 5, maybe 6 seconds. But anyways, if you buy the close of bar three on the doji, think to yourself for just a few seconds. And if you're watching the replay, maybe pause the video and ask yourself, what is three telling you? Three is a pause after a breakout. And I mentioned yesterday in the Q&A review, I'm hoping to do a discussion over the market cycle sometime early next week, maybe Sunday. In other words, 6 days from now, possibly Sunday. However, it'll probably be Monday. Anyways, the point is, as far as the market cycle, whenever you get a breakout and then a pause, that pause is the start of the channel. So bar three is probably the start of the channel. So bar four, strong bull bar, and then 5 weak doji. So look at this. We're getting strong bull trend bars and weak doji bars. Whenever you get a strong bull trend bar like the close of bar four, and then it immediately pulls back, that tells traders that the market, traders are not buying closes, they're buying pullbacks. And then 6, we went outside up. So this is not what you want to see if you're hoping from a trend if you're hoping for a trend from the open. Right now we have a bull trend from the open, but as you know, there's a 60% chance that this rally will evolve into a trading range. And then 6, obviously there's probably buyers below, but remember what I said about the open of bar 1? It doesn't seem obvious, but the probability is much higher than what it appears that we're going to fall below the low of the day. I'm going to go ahead and mark the open of the day because it's also the open of the week. Seven, a little bit of a surprise, may get a small second leg down. So decent bear bar on 7, probably a second leg down, likely, but a leg in a trading range. For the bulls, if they bought below 6, they're probably disappointed on 7. And the biggest thing, if there's one thing I hope traders can take away from this video, especially talking about the open, is the first 12 bars of the day. The market is deciding on a lot of variables. It's deciding how it's going to react to yesterday's price action. It's also deciding on what the structure of the day is going to be. So there can be a lot of reversals on the open of the day. That's why a lot of traders, and that's why I say in the blogs, Most traders are better off not trading the open. They're better off waiting for the first 6 bars. So if you find yourself on most days getting chewed up on the open, just don't trade it. You don't need to trade the open. You don't need to be at your computer at the close of bar 1 or the close of bar 2. Wait till the close of bar 6, and better yet, wait for the close of bar 12. You just don't need that many great trades in a day. You don't need that many trades in a day to really figure things out. 7, reasonable bear bar, probably going a little bit lower, but no surprise, bad follow through bar. For the bulls, it's a failed breakout below 7 and reversal up. You can call it a high 1 buy. But what do you think the bears are going to call this? The bears, they bought below 6, and the bears, they sold the close of 7. And they're hoping that 8 is a pullback. And the bulls, what about the bulls that bought the low of 6? Do you think they're excited about the follow through 7? Of course not. They're disappointed. And those traders, because of bar 8, what do you think they're going to do? A lot of those traders are going to look to sell out of longs above bar 8. So bar 8 might be a trap, trapping bulls into buying high. By the way, I know there's been a few comments about traders not liking how I or even Al talks about each bar back and forth, and it's confusing, and it seems like there's uncertainty in the price action. When you're reading price action, you have to learn to be used to talking about both sides. If you cannot talk about both sides and you're favoring one side on most of the bars, that is a warning that that's a warning that you are misreading the price action. There's always, at least, you should always assume, in general, there's at least a 40% chance of the opposite happening. And no matter how certain you are here with this sell off that it's going lower, you should always assume there's a 20% chance that any bar can be a really strong bull bar that just wipes out your stop. You should always assume that. Always assume your trade, no matter how strong it appears, there's at least a 20% chance it's going to fail. And what I mean by that is it's going to fail really fast. 20% chance something crazy happens. Rally, big bear, some sort of report bar. But at least a 40% chance that you're in the wrong direction. And that's okay. So at best, 60% chance you're in the right direction. And at worst, 40% chance you're in the wrong direction. 9-second leg down, bear breakout 7, pause 8, 9-second leg down. But again, we're probably going to fall below 1, and we'll probably test the moving average. We have these breakout points below. So if we're in a trading range, the market loves breakout points, and it's probably going to try and test these breakout points. 10, now we have a micro channel since 6, so 4-bar or maybe 5-bar bear micro channel. Probably buyers below 1, scaling in lower. So I suspect that the market's going to go mostly sideways. And then 11, we have another bear bar. But what do you notice on 10 and what do you notice on 11? There's a big tail below 10, big tail below 11, and that increases the probability that there's going to be traders buying down here to take profits. But there's also probably sellers above. So it's a bear breakout. Odds are first reversal up will fail. 12, another bull bar. So on a micro channel, it's a wedge or a failed breakout of a channel on a smaller time frame. So if we go to a 1-minute chart, you're going to see that. And that's why we're pausing on 13. 13, more sideways trading. Odds are the first reversal up will fail. And then look at 14. 14 is testing above these bars. A lot of overlapping bars. That increases the probability that the market is probably going to pull back fairly soon. And then 14, we had a low 1 short. What about selling below the low 1? Traders will sell below the low 1. But a lot of traders, instead of selling below it, they'll sell the midpoint of the bar. Why would they sell the midpoint of the bar? Because a low 1 typically leads to buyers below before their low 1s often have buyers below. And that's because traders will sell the close. They'll sell as 13 is going down on some time frame, and they're disappointed by the pullback to the 14 high. And because they're disappointed by the pullback to the 14 high, there's probably going to be buyers, at least temporarily, buying back shorts. Bears buying back shorts, bulls buying to go long. And sometimes I'll take that trade. If I feel like being really aggressive, I'll buy the low of 14, and I'll try and scalp out around the midpoint of the bar. But the more important piece to that trade is actually the sell up here. So if you're buying the low of 14, it's a very time sensitive trade because you know there's an unknown number of bears selling somewhere up here. Low one shorts, even the ones that typically have buyers below, especially when the trend is when there's a reasonable direction, market bias. And here the market's always in short. So when you have a low one short in a tight bear channel, it's usually better to assume that it's a trend resumption pattern rather than a trend reversal pattern. So if you're ever buying a bar like 14 and then you get another bear bar closing on its low, it's usually better just to get out of the trade. And 15 closed on its low. But do you see what 15 did first? It rallied to the midpoint of the bar and then sold off. 15 bear bar closing on its low. Is it a sell to close bar? It might be, but sell off, pause, sell off, pullback, sell off, pullback. All of these tails are pulling back. And it's possible 15 is an exhaustion bar. And no surprise, 16, it rallied above the 15 close. So what about buying the bull bar on 16, betting that it's an opening reversal? Some traders might. The 16 is a big enough bar alone that it'll probably lead to at least a small second leg up, but it's a minor reversal. The reality is, anybody who's sold the close of this bar right here, guess what? You know they're probably going to make money. If you're a bear and you sell the close of 15 and you put a stop all the way up here and you sell more above 15 and then maybe more a measured move up around the open of the day, the chances are really high you're going to either make money or break even. So 16 bull bar, and it's an outside bar. That's a trading range bar. Outside bars are trading range bars. Now, why are outside bars trading range bars? Because they have a lot of overlap with the prior bar. And when a bar has a lot of overlap, that increases the chances that there's sellers not far above. So even though 17 is consecutive bull bars, look where you're at. You're at the open of the day. Whenever you get a big rally, like bar 1 through bar 4, right on the open, it's usually best to assume that the day is not going to be a bear trend day. Sure, you might get a measured move from the high of 6 to the low of 1. You could certainly get that. But the odds are against a strong bear trend day. So 17, we have a tail on 16, tail on 17. There's probably sellers not far above, and we're probably going to test the 15 high and maybe get down to the 15 close. But I think 16 and 17 is also strong enough for at least a small second leg up. 18, bear bar, it's a pause. Just like some of these traders that sold and sold more higher, they're trying to get out break even. So that's what that means is 16 and 17 is strong enough for a second leg. Therefore, there's probably buyers below 17, buyers below 18. 18 is a low one short. You can also call this an expanding triangle right here. But even though it's an expanding triangle, it's probably more of a trading range. Whenever you get a trading range after a breakout, especially something that's a dominant feature like this, we have a sell-off and then a trading range. The market's deciding on trend reversal or trend resumption. Now look at the sell-off down to 15, and what do you notice? Here's the 75 low. Here's the bar 6 high. And surprise, surprise, this is a 50% pullback of yesterday's low, Friday's low, and the high of bar 6. So the close of 15, as strong as it looks, is a 50% pullback of the opening range. And that's in part why we bounced here. And whenever you get a big gap like this, usually you get some form of a second leg. And it's possible that bars 1 through 4 is not the second leg, it's part of the first leg. And if it's part of the first leg, we may get a deep pullback and then a transition into a large trading range. So 18, bear bar, probably buyers below, and then 19, strong bull bar. What about buying the close of 19, betting on a reversal and a test of the bar 6 open or the bar 4 close? I would not. 19 is the second leg after 16 and 17. And the odds were high that 16 and 17 would lead. The odds were high that 16 and 17 would lead to a second leg up, which is what happened on 19. But the odds are not high that 19 is going to lead to another strong leg up. So, as far as buying the close of 19, some traders might, but you're buying awfully high in a trading range, right at a 50% pullback from the high of 6 to the low of 16. Therefore, if 20, the next bar is a bear bar closing on its low, that's a really dangerous bar to be buying. And 20 is a subtle bull bar. What about selling below 20? Some traders might. The one thing going for the bulls is all the bull bars. And let me back up. The one thing going for the bears is the lack of follow through after breakouts. So 19 is a bull breakout bar, but 20 is a weak breakout bar. And because 20 is a weak breakout bar, 20 is a strong breakout bar, but 21 has bad follow through. And because 21 has bad follow through, you will see traders selling up here rather than buying. Let me get a sip of water. I know I could have explained that better. What I'm trying to say is we have a big bull bar and then a weak follow through bar. So think about it: strong momentum and then zero momentum. You want this strong sell off and then more lower prices. You don't want a big bull bar and then no follow through, because that's a sign that it's more of a vacuum. Everybody stepped aside until we got to a price level like the 9 close, and then they started selling. And that's why 21 went outside down. Let me just check something really quick. There we go. So 21 outside down, 2 legs up in a likely trading range. Testing the breakout point of the 8 low, that will increase the probability that the market is going to go sideways to down. So remember that red line all the way down here? I mentioned that 15 close. Traders sold this close and scaled in higher. So what do you think those bears are going to do? If I'm a bear and I sold here and I sell more up here, guess what? We could easily sell off all the way down here. That's why buying in a trading range, whenever traders are buying up here, and you heard me mention that I mentioned a rule, a good rule to write down and memorize. If the if you have a first leg, do not fade it. So if you have a breakout and follow through, you're going to get a second leg. The odds are extremely high, like 90% you're going to get a second leg. The second leg doesn't have to be big though. But when you have the second leg, especially in a trading range, there's a much lower probability of a third leg. So if you're buying below 21, or if you bought the 20 low and then 21's a bear bar closing on its low, why do you think Al all the time says if this bar is a bear bar closing on its low, I would get out? Because most of the time the market is in some variant of a second or third leg. So a good rule of thumb is whenever you're in a trading range and you're long and it's possible and it's a second leg up and you get a bear bar closing on its low, just exit the trade and look to buy again lower. It's not worth scaling in because the scaling could go all the way down here. Another rule of thumb is when you think you're in a third leg. So let's find a leg 3. I'm sure we could find one. So maybe here we had a sell off, pause, and then a second leg down, pause. 41 is an attempt at a third leg down. And that's a much lower probability, because if we sell off and we fall below 38, that would be a third leg down, and the odds would be really high of a reversal. I'm not finding exactly what I want. Maybe here, leg 1, pause, leg 2, pause, leg 3. This has a much higher probability of a reversal than what it appears. And that's why a lot of moves in channels, it's really common for channels to get these parabolic, these micro channels late in the channel. So you get this channel, this spike, pause, and we start to channel up right here. But then you get this strong breakout to the upside late in the channel. And normally it'll break out above the top of channel lines. But whenever you get that, it's a parabolic move. So if you want some homework, go to wedges. There's the videos on wedges. I forget what number it is, but it's in the reversal section of the prerequisites of the fundamentals of the Brooks trading course. If you go to wedges, you'll hear Al talk about third legs and wedges and how they're often climactic, and that's exactly what this is. But the rule is don't trade in the direction of the third leg. Usually, third legs are better fades unless the market is in a small pullback trend. So, anyways, 21 outside down, 22 follow through. Consecutive bear bars, probably going to get a second leg down in a test of the 15 close. And then 23, a give up bar. What about selling the close of 23? Well, if I was a bear and I sold the close of 15 and I sold more higher, do you think I'm looking to sell more down here, or do you think I'm looking to cash out of the trade? I'm probably disappointed at the 15 close. And I'm thinking, darn, that was a terrible sell, but at least I'm going to make something because I sold up here. Maybe I should just exit the trade entirely and move on to something else. And that's why 24 had a bounce. 24 is a double bottom, it's a bull bar, and it's a reasonable buy above the bar, but there's one problem for the bulls. It's a double bottom. There's really two issues. One, you're fighting against three big bear bars, 21, 22, 23, and it's a micro channel. It's a 4-bar micro channel. Plus 24 is an inside bar. Inside bars are typically they're trading range bars. An inside bar is a contracting environment. So if the market's contracting, that increases the probability that the market's going to go sideways. So any breakout above or below 24, there will be a magnetic pull back to the center of 24 or the midpoint. The other issue with 24 is we have not reached the 15 close. It's good for the bulls that we didn't reach the 15 close. It gives them the opportunity to trap the bears who sold the 15 close. But the problem I have with 24 is it might be, sorry about that, it might lead to a lower high in a test of the 24 of the 15 close. There might be sellers up here and we get a second leg down. Well, look what happened. 24, we tried to get a second leg down after the sell off 21 to 23, but instead everybody bought it. So you have trapped bulls, you have trapped bears who sold above 24 and now they're trapped. And you have bulls who did not buy above 24. And now those bulls are having to decide what they do above 24. And look what happened. We rallied all the way back up to the 20 low, and then we found sellers. And now we're pulling back, testing the 24 high. So we're allowing the bears who sold above 24 and scaled in to make money. And the bulls who bought above 24 are scalping out. So probably more of a trading range. 27, buyers below 26. Obviously, we're forming some variant of a triangle. So the market's contracting. Is that the triangle? Maybe. Is this the triangle? Sure it is. The whole point is we're contracting. The range is getting squeezed. 27, breakout pullback buy. The bulls, some bulls will buy above it, hoping for a rally, but middle of a trading range, not ideal. And then 28, bad follow through. Bulls buying the close of 25. Disappointed 26, trying to get out at the high close. That's why 28 looks the way it does. And then 29, bull bar. So we have a second leg up after 27 and a second leg up from 24 and 25. What about buying the close of 29? Some traders might, but I think at least 50-50 chance there's sellers up here. 30, consecutive bull bars. Probably buy the close for at least a second leg up, but you're high in the range. Traders are hopeful that this is the start of a breakout of a triangle that leads to a test of Friday's high and the high of the day. I mentioned somewhere around here in the update of the blog that the 18-bar range has not been exceeded. And whenever the 18-bar range, there's a high probability that you're going to either break above or below the 18-bar range. That's why the number 18 on this chart is blue, because it serves as a reminder of the 18 bar range. And here's the high of the 18 bar range, here's the low of the 18 bar range. And the odds are we're going to go above one or the other. Because of the gap up and the follow through from 1 to 4, the odds might slightly favor an upside breakout compared to a downside breakout. Plus, we're oversold on the daily chart. But neither way, you don't have to know that. There's no reason for the bears to sell right now. Give me just a moment. Anyways, because of the consecutive bull bars, 29.30, probably at least a small second leg. 31, 3 consecutive bull bars. It might be by the close, but the bodies are smaller. I think it's better to wait for one more bar. And 32, a bear bar. But after the tight bull channel, the 27 low to the 31 high, 32 might be a pullback, and there's probably buyers not far below. And then 33, second leg up after the rally to 31. But the problem for the bulls now is we have a leg up to the 21 high pullback, and then we have a three-legged rally up to 33. So one push up, two pushes up, three pushes up. You can also make the argument we're in a channel and maybe we have a little bit higher to go. But either way, the bulls do not clearly have an upside breakout. And because of the wedge, we might pull back at least a little bit. And that's why 34 is another bear bar. So we're going sideways and in a tight trading range, and the market's fairly neutral. It's easy. The longer you trade, the more you start to see all these patterns. The market is filled with with the market cycle. It's a spike and it's kind of a repeating pattern. 1, 2, 3, reversal, 1, 2. So in other words, a spike, pullback, channel, 2 legs up, reversal down. But anyways, the point with that is all of these bars, there's a series of 2 and 3-legged moves and then reversals. And the most thing you can realize in this is we're right at the open of the day and we're in a tight trading range, and the probability is really close to 50-50. The bears want a second leg down from the sell off to 15, so they want a leg one, pull back to one of these legs, and then a second leg down, testing these lower highs. And the bulls, what do the bulls want? The bulls want the opposite. They want an upside breakout. So 34, 35, 36, 3 consecutive bear bars, sellers above, and a second leg down. And then 38, we have a bear bar closing on its low. And then 39, a bear breakout. For the bears, it's a test of the 23 close as well as the 15 close. Are we always in short on 39? I don't think so. It's a surprise bar and it may get a second leg. But one of my concerns with 39, let me redraw a few things. One of my concerns is this: the leg one on 32, leg three on 36, leg two on 36, and then leg three on 39. So if 40 is a big bull bar closing on its low, it could be a failed breakout and a reversal up. It would also be another higher low right here. And instead, there's 40. 40 is reversing up. So this is what makes trading ranges so hard for a lot of traders, is there's all sorts of trend lines. And you never know. You see a bar like 39 selling off. You never know if it reverses up on the next bar. That could be the extreme of the trend line. And that's why a lot of traders count legs. Now you can draw all sorts of trend lines, but the important piece is just to recognize the overall context of the market. So 40 bull bar reversing up. Is there sellers above? There might be after 38 and 39, but 40 is certainly a problem for traders who sold the close of 39. They're disappointed with 40, and therefore in 41, the low one short. You know what I'm going to say? A lot of those bears who sold the close of 39 will probably look to buy back shorts. And then 42 bull bar, so it's a second entry buy. Probably buyers above 42, and bears, they might look to give up. So it's an okay swing buy. It's a second entry buy, betting on a test of the rally back to the 6 high or breakout above the 33 high. And then 43, we have a weak entry bar, but it's at least a bull bar, and it's a bad sell below 43. And then 44, now we have 3 consecutive bull bars breaking out of this minor bear flag right here. And the next, the bulls want to break out of these bars over here. 45, bear bar, pullback after 44. Probably buyers below, with it being in a 4-bar micro channel from 42 to 45. But still, you're right at the open of the day, so the probability is not all that clear. 46, bull bar. The bulls still trying to get the upside breakout. And then 47 changed the characteristic of the day. So we're in a tight trading range, and the market is making a statement with 46. 46 trapped all the bears who sold anywhere. And let's look at 46 for a second. So that's 1320 to 1325. Look at that. When you're looking at a chart, this is why I reference a 1-minute chart sometimes regularly. What do you notice about this? So we have a big bull bar, another bar, another bar, another bar. This breakout has a lot of this breakout's not getting any pullbacks. And if it continues to go up like this, it becomes an even stronger breakout on a higher time frame. So that's why it's probably an okay buy the close on this bar or an okay buy the close on the next bar. And by okay buy the close on this bar, I mean okay buy the close of bar 47. 48 follow through, still probably okay to buy the close, but high in the range and a possible second leg trap. Leg 1, pause, leg 2. And then weak follow through bar on 49. 49 breaking out above the six high and reversing down. So profit taking at the 6 high, that's a sign you're in a trading range. And then 50, bad entry bar for the bears who sold below 49. It's a high one buy above 50, and there's probably sellers above. Some bulls buy the close 48. They scale in higher, getting out break even. However, it's probably a minor reversal down, which means there might be sellers above 50 high, but even if there are, there's probably buyers not far below. 51 bull bar closing on its high. Good for the bulls. It's possible trap for the bears that sold the 50 high, and then 52 consecutive bull bars. Now the bears, they are getting trapped. You can see what happened. They sell the 50 high, disappointed 51, and the high of bar 50 is 80.75, and the low of bar 52 is 80.75. So that is a perfect trap. The bears sell the 50 high, disappointed with 51, and then they scramble to get out break even, and 52 is not letting them out at break even. And then 53, more bulls are buying, and more bears are giving up. You had other bulls who look at 50 and say, that's a bad high one. I'm going to wait for the breakout. And then they see 51 and 52, and everybody starts buying on the close at 52. And then 54, it's a bull bar, but it's a big tail below the bar. So instead of buying the close at 53, a lot of traders took profits on the close at 53, and that lowers the argument for the bulls. So it's possible that there's more sellers above 54 than buyers. Whenever you get overlapping bars, that's a reminder that the market's probably in a trading range. 55, another inside bar, so there might be sellers above. And 56, no surprise. It's relieving the bears who are trapped. They sold, scaled in, getting out, break even. 57, consecutive bear bars. What about selling the close of 57? I would not. This is probably getting close to the buy zone for the bulls who bought, for the bears who sold above 50. We might go a little bit we might go a little bit lower, but I suspect there's buyers not all that far below. 58, doji, probably sellers above. Type bull channel, and because you're in that buy zone where bears will probably look to buy back shorts and bulls will probably look to buy, we're probably going to bounce further than what the bulls want. 59, doji, bull bar, but probably sellers above the bar and a second leg down and a test of the moving average. It's possible we have to test the 50 low. 60, inside bar, the start of a second leg down after the sell off to 58. And instead, we got a bull bar on 61. For the bulls, they're trying to trap the bears who sold above 58 and disappointed with 59. And a lot of those traders, if they sold above 58 and scaled in, they might look to get out break even. It's a weak low one short near the moving average, so there's probably buyers below. And then 60 is trying to get an upside breakout. And then 61, consecutive bull bars, but a possible wedge, 49, 54, and 62. So because it's a wedge, reasonable to assume we'll get a two-legged pullback. 63, high one buy, but because of the wedge, there might be more sellers above 63 than buyers. 64, follow through, so traders buying above 63. But now you have a parabolic wedge for the third leg, 59, 62, and then 64. And then obviously 65, a surprise bear bar. The bear bar, it's a little bit of a surprise, but it's following 4 bull bars. That will lower the probability of traders selling the close of 65, this big bear bar. 66, another bear. It's a bear bar, but it's a weak follow through bar. Probably sellers above for at least a second leg down, but it's really not all that ideal. We're probably going to go sideways. And you can see the close of 67, a big doji bar. So that's disappointing. And then 68, another inside bar, probably buyers below, probably sellers above. And 69, 70 trying to break out to the upside. 71 breaking out above the upside. So another way to look at this is we have a spike, pullback channel right here. Several ways to draw the channel. And we're trying to break out above the channel. But because the bears who sold above 54 during 62 made money, reasonable to assume that the bears who sell above this red horizontal line, the 67 high, are going to make money. And they are on 72 and 73. 72, possible wedge. So it's okay for bulls to exit below 72. And then we went sideways to down into the close. So no surprise. Remember what I said about a market cycle? Breakout, pullback, start of the channel, the market channels up, and it generally will test at least 50% of the channel. And that's 50%. So for stop entries, I thought it was okay to buy above 1 or buy above 2, but it's really aggressive. And if you are buying above 1 or 2, you got to be really quick. I'd get out below basically any bear bar. You're taking a chance it's a trend from the open. As far as selling below 6, with it being a micro channel, I would not. We could easily get a second leg up. And then when you get 7's a surprise bear breakout. You can sell below 7, but because it's in the middle of the rally from 1 to the 6 high, I thought it was better to wait and see the pullback. And then when you see 9 closing on its low, probably an okay sell. Taking a chance we're going to test the 1 low. 10, what about selling below it? Some traders might, but not really ideal. None of these are really great sell below bars, and they're better limit order or sell the close bars. okay to buy above 16, but a probably minor reversal. So minor reversal implies two legs up and then a reversal back down, which means bulls get out below 21, bears sell 21 or 22, but they probably get out above 24 because you're in a trading range and now you have a double bottom, 16 and 24. If you buy above 24, you might get out below 26, but I don't think you have to. If it's okay to get out below 26, it's the middle of a tight trading range, and it's probably best to get out below 26. But if you do you buy again above 27? I suspect traders will. Or if they don't buy above 27, do they buy up here? Some might, but then if you start to go sideways, I think you have to get out. And then here, what about selling below bars? I think it's a better sell above bars. And that's why they waited for a bull bar like 37 and started selling. And then 38, it's an okay sell, betting on some form of a lower high, major trend reversal, head and shoulders top, left shoulder, head, right shoulder. You can also call it a bear flag, double top with 21, or a failed breakout above 21 and a reversal down. But then when you see 39, what about selling below 39? I don't know. I would not. I don't think it's all that ideal. And then I thought it was okay to probably buy above 42. 42 is the second entry buy. And the bears that were short, I think they have to get out above 42. And I suspect a lot of them would get out below 41 or above 40. But definitely above 42, which makes 42 a reasonable buy. You can wait and buy above 47. You can even buy above 48, but you're right at the high of the range. Better to probably wait and see what the pullback looks like. And then 51, 52, I thought it was okay to buy above 52, but it's probably a scalp because you know there's sellers not far above. And then maybe buying above 60. And then in here, I think it's pretty challenging. If you buy above 60, what do you do with 65 or 66? Probably going to go sideways. There's probably sellers above 66. But with the bull bars, 61 to 64, I thought it was okay to buy the low of 66, betting on a second leg up, or the low of 68. But then at some point, when you see a bar like 72, bear bar closing on its low after several reversal attempts, 1, 2, 3, and then here's the fourth, I think a lot of bulls will exit below 72, or certainly above 73. Too much risk of some form of a pullback in the evolution into a trading range. Limit orders, I thought probably sellers, maybe a measured move up of 3, at least profit taking. Sellers above 5, probably buyers below 5. But so far from the moving average, if you bought below 5 and you didn't get out during 6, I think you have to get out near the close of 6, or 7 starts to turn down. Probably sellers above 8, but never triggered. And there's buyers below any of these bars. I thought sellers above 13, buyers below 14. But if you're buying below 14, it's a scalp at the midpoint of the bar, and it's a pretty quick trade. And then buyers below 17 or 18, but never triggered. Probably buyers, maybe buyers below 20, but if you don't get out as 21 rallies above 20, I think it's a missed opportunity. And where I'm getting at is if you buy below 20, you have to exit below 21. So if you didn't get out during 21, you have to exit at the low of the bar. And then there might be buyers below 26, but it's a big bear bar, so not ideal. And then there's probably sellers above 21 or above 26 scaling and higher. And the same with bar 37, probably buyers below 41 and buyers below 49 with consecutive bull bars. And then if you bought below 49 and 50 is a big bear bar closing on its low like 9, you just take your loss. Buyers below any of these bars. And then buyers probably below 66, probably sellers above 67 or 64 during these highs. And that's probably it. For buy the close, sell the close, I thought it was buy the close on 2. I thought it was sell the close on 9 or 10. Probably buy the close of 17 or 18, betting on a second leg. Maybe sell the close of 22, betting on a test of the 15 close. And then in here, I thought it was really difficult to buy the close, sell the close. Probably buy the close 49, 47 or 48, and then probably buy the close, maybe buy the close 52 or 53, but not ideal. And I don't know if any of this was buy the close or sell the close. Let me take a look at questions. Okay, reading through the questions now. By the way, the the trick with trading, and maybe this individual is listening, but one person described trading as discretionary trading as being very organized with your thoughts. And what that implies is when you're trading from a discretionary standpoint, you have to have the information. You've got to have the knowledge to trade. So it's kind of like you got to understand the encyclopedia. And if you're sitting down with Al and you're talking about the encyclopedia or the encyclopedia, I mean the trading course. If you're sitting down with Al and you're talking about the trading course, or if you and I are talking about the trading course, you got to be able to play tennis. You got to be able to hit the ball over the net. And if we're talking about major trend reversals, carry the conversation forward. So you need to be able to understand how to talk about the terminology and understand it. But the next piece is you got to be able to have it organized in your mind in such a way that you can extract the information. And the reason I'm saying that is one way is to really understand leg counting, which is the market cycle. So you have a breakout and then a pullback, and then that pullback leads to a channel. That channel usually gets another two legs up, which creates a wedge. And then the wedge usually evolves into a trading range. And then the trading range is breakout mode. That happens over and over and over each and every day. So that's going to be one big topic I want to discuss in the upcoming webinar on hopefully next Monday. I'm going to check with Richard though. But as far as that webinar, you have to have the Brooks trading course to listen to it because there might be some slides from the Brooks trading course included in that webinar. Therefore, it's only fair that the members who have purchased the Brooks webinar would have access to it. Anyways, back to questions. Question: does expecting a second leg after a strong breakout expecting high probability trade or not? If not, how can we know the probability of the second leg's not high? Yeah, the probability of a breakout getting a second leg is very high, especially when it's in the confines of being the leg one. So how do you know that? For me, I like to think of leg one as being a surprise, a change in the market cycle. Here's a big bull bar, 47 and 48. Do you think that changes the market cycle? Sure. We have a trading range here. We break above it. We broke above it. So any pullback is probably the start of a second leg. Therefore, there's a very high probability you're going to get a second leg up. It doesn't mean you're going to get a measured move of these bars. And often this is really common. You have to wait for a lot of bars to get the measured move of 47 or 48. But if you're buying the pullback and scalping out, betting on a second leg, that probability is so high, it usually only goes up a little bit before it pulls back. How do you know that when the probability is not high of a second leg or another leg? Yeah, generally when the market's in leg 3. So let's find an example. 33 is an example. We had a breakout. We were in a bear sell off, and then we broke out on 25, paused on 26, rallied up to 30 and 31. So it's possible 25 is leg 1, pull back, 30 and 31 is leg 2. Then we paused, and then 33 is leg 3. So there might be more sellers up here than buyers. Same thing down here. We sold off on 32, rallied on 33, sold off to 36. That might be the second leg down, and 32 be the first. And then we sold off to 39. That might be the third leg down. And because of that, selling above is probably a mistake. The sellers that are selling above are probably the trapped bears who are short trying to get out without a loss. Okay, question. Initially, I set my risk reward ratio 1 to 2 or 1 to 3. I'm assuming that means your risk is 1 and your reward is 2. In other words, your risk is $1 and you're trying to make $2. But as the trade goes, sometimes I am forced to exit before my initial profit target because my premise changed. Doesn't that trade change the trader's equation? Sure. The trader's equation is basically whenever you take a swing trade, there's a 40% chance you're going to catch a very big move. So if you buy above 42, there's a 40% chance that the market's going to go all the way up here and you're going to get some form of multiple, several times your risk. There's a 60% chance that this is going to happen. You buy above 24, you get a second leg up and you get out somewhere up here. You sell below 21, you get a couple of bars down and then you get out above 24. You sell below 34 and you get two legs down and you get out above 40, bar 40. That happens all the time. But as far as when your premise changes, you always want to get out of the trade. Just because you sell here doesn't mean and your target's down here, it doesn't mean you should hang on forever hoping that it gets there. At some point, you have to manage what the trade is doing. Okay, continued, because sometimes the market goes our way a little bit and then it reverses or stalls. So is it okay to take whatever profits we can instead of losing all in the hope for the market reaching the target? Sure. I think one of the mistakes traders make is I think the one thing you cannot do is you buy 42. You've been taking all these trades and maybe you're basically break even on the day. I think it's really dangerous to buy above 42 and then get scared on 45. There's a pipe above me, and I don't know if it's because I'm in Texas, and the weather has gotten exceedingly cold this week. And I don't know, sometimes when the weather drastically changes, there's a clicking sound with the pipe that hasn't happened in, basically since last time it got cold. So I was hoping to give it a second and hope it would go away. But, anyways, we're going to finish the webinar. But as far as your question about what do you do when the market goes your way just a little bit and it starts to stall or reverse? Whenever you're short here and you're hoping for a large downside breakout, and then you see 21 and you see 22 and 23, you have to be able to exit the trade. So if you're short and then you have a double bottom, you got to get out. And that happens all the time in a trading range. Can you sell below 26, hoping for a breakout below bar 18? Can you sell below 26 here, hoping for a breakout below the 18 bar range? Sure, you can sell below 26. One of my problems with selling below 26 is we had such a strong rally from 25 to the 26 high. That 26 low is just a pullback, and it's a test of the breakout point 24. So we might get a second leg up. But if you sell below 26 and then you see 27 and then 28, I think you have to get out and basically accept that your premise is probably no longer valid. Do you suggest that after mastering the video course, we should study the trading room first or the encyclopedia? I think both are important. I think what's most important about the trading room is just to understand how a trader thinks. That's why I was in the room for so many years listening to Al. I wanted to understand, Al, it didn't take me long to realize how comfortable Al was talking about the market. So I wanted to get a better idea and understanding of how Al was so at peace with what the market was doing. But both are important. So it looks like that's all the time I have for questions. But, anyways, as far as if I did not get your question answered today, you can ask it tomorrow in the trading room. And other than that, tomorrow it'll be interesting to see, will the bulls get follow through or will the bulls be disappointed? I still think the market is going to try and get up to the October 3rd low. However, I don't know if we're going to go straight up. We might have to go sideways for several bars and then try and break out. Like right here, we had to form a bottom before we got back to. So right here, we had to form a bottom before we got back to the October 18th low right here. In other words, before this rally happened, we may have to form a bottom for a lot of bars here before we get a rally to the upside. All right. Hope everyone has a good rest of their day.